Hello, and welcome to today's lesson that we cover under the topic of companies. Today we'll be focusing on some year-end adjustments and trying to understand some basic examples. We will first start with the importance of adjustments and then move on to types of adjustments we can expect to see, and thereafter ending off with some basic example questions of adjustments. The reason for year-end adjustments is to ensure that financial statements comply with international accounting principles. So generally you'll come across in a paper that you'll get a pre-adjusted trial balance or a pre-adjusted income statement or balance sheet or cash flow statement. There are some adjustments that are only picked up at year end, and these additional adjustments will then have to be accounted for to finalize the financial statements that need to be submitted. Some types of adjustments you can expect is accrued expenses. So accrued expenses are expenses that have to be paid at year end and are still outstanding. Prepaid expenses, these cover, this is an asset. A prepaid expense is expenses that have been paid in advance of the current year but relate to the expenses of next year. So for example, if you have paid for your water and electricity balance in advance, you've paid maybe 2 months of your estimated balance in advance. For next year, you have not utilized that water and electricity for next year. So therefore, you can't include it as an expense in the income statement. Remember, the income statement includes income that has been earned and expenses that have been incurred. So these expenses that I'm discussing are not incurred, but they have already been prepaid for. Accrued income is income that has to be received at year end. So this is where you've provided the service, but you have not yet received the income from the client. Income received in advance is basically the opposite of accrued income. This is where you have received the money in advance, but will provide the service to the client in the following year. Now you have not earned the income, so it won't be in income statement. But because you have received the money, you'll therefore need to raise a consequential liability called income received in advance. This reflects your liability or obligation to provide that service next year. Consumable stores on hand refers to consumable stores that is not used at year end, and this includes stationery, packing material, cleaning materials. Sundry materials used for rendering services. So what happens is you'll therefore have to create an asset for this amount that's still sitting in your warehouse or storeroom. You'll have to reduce the expense amount in your income statement and reflect it as an asset because that amount cannot be expense as it has not been utilized as yet. Trading stock on hand and trading stock deficit and surplus. So at year end, you will have an accounting or theoretical trading stock balance that has been calculated after all journal entries have been processed, and those that impact in inventory or trading stock have been calculated and summed up together. However, in your warehouse or storeroom, the physical inventory that you have may differ from the theoretical accounting number in your accounting records. And this can be for numerous reasons. They could be inventory that was stolen or damaged, or inventory that is obsolete and needs to be get rid of. Or on the accounting side, there could have been recording entries, mistakes in recording the numbers or the journal entries. So for us to ensure that the trading account theoretical number that's sitting in our accounting books reflects what is actually in the warehouse, we do a stock count. We compare what's in our warehouse to the balance in our books, and therefore we'll see whether we need to adjust the balance to reflect what is in the warehouse. Remember, the accounting number must always reflect what is in the warehouse, what we actually have. Now, if what we have in the warehouse is more than what we have in our books, then we will have to increase the balance in our books, and that will result in a surplus. If what we have in our warehouse is less than what we have in our books, we will have to decrease the balance in our books, and that will result in a trading stock deficit. A surplus will be reflected as other operating income, and a deficit will be under operating expenses. Provision for bad debts and bad debts. A lot of students tend to get confused with these two. So bad debts reflects the expense for actual debtors or clients or customers that owe you money, and there is evidence that they will not pay you. So this relates to actual clients that come to you and say, I'm insolvent or I'm unable to pay the full amount owing to the company. You will then write them off by debiting bad debts expense and crediting debtors control. Provision for bad debt is more of an estimate. It is based on past experience with clients that each year the customer estimates what percentage of their outstanding debtors balance will have to be written off or will become bad. Because this is an estimate, year on year, this estimate may change as the company gets more information, and we will have to adjust this provision for bad debts. Provision for bad debts is a negative asset, I call. It is subtracted from the debtors control balance in your balance sheet to give you a line item called net trade debtors. Provision for bad debts increases on the credit side and decreases on the debit side. And we will be going through an example just now where I will show you that transaction. Depreciation, it is reflecting the use of an asset in the company, and this results in a decrease of the carrying value of non-current assets. We depreciate it either using a straight line method or the depreciating method, which is based on your carrying value at the beginning of each year. Okay, now let's work through some basic examples. So this basic example is from a company that has a list of balances as of 31st December 2021. This means that's the year end, and the start of the year will be 2021 January 1st. We will be reflecting back on the slide several times to get the different line item numbers as we work through examples. So as you can see, we have provision for bad debts, rent income, audit fees, rent expense, directors' fees, advertising, and bad debts. Everything other than provision for bad debts is an income and expense item that you'll find under your nominal account section. Provision for bad debt will be a negative asset. Okay, here's our first example. So 75% of our annual fees for audit has been paid. If you can see here, audit fees is 65,400. So what is the adjustment needed? Well, we've only paid 75%. We need to pay 100%. So 75% of audit fees is, as per our balances, 65,400. In order to calculate 100%, we will say 65,400 divided by 75%. Going to bring up my calculator. You say 65,400 divided by 0.75, which is 75%, will give you 87,200. That means we still need to account for some audit fees. 87,200 minus 65,400. That gives you 21,800. This means we are going to have to still recognize audit fees. So the journal entry will be debit audit fees. This is the expense that will go in your income statement. So we are increasing it by 21,800. And because we have not paid this as yet, because only 75% has been paid, we are going to credit trade and other payables for 21,800. So this is a simple example of where we have not accounted for the 100% of the annual fees, and the 25% that has not been accounted for is a liability because we have not paid it. Okay, let's move on. Directors' fees. The director company has 3 directors who earn the same fee. One director was paid 12 months in advance. So the total director fees expense was 497,800. So I'm going to put that here. The total is 497,800. Now let's assume a monthly director fee is equal to X. Okay, an unknown amount. The first director will receive a monthly fee for 12 months. So that's 12x. The second director will receive a monthly fee for 12 months. Again, 12x. The third director will receive for the 12 months plus 2 months more that were paid in advance. So that makes it a total of 14x. To give you the total amount of 497,800. Now, if we solve for x here, it will be 38x is equal to 497,800. And let's solve for the monthly amount. So 497,800 divided by 38, a monthly amount is 13,100. Now remember, there was 2 months paid in advance. So this will be 2 times 13,100. And that will give you 26,200. Now let's think about the journal entries. We paid it in advance, so the amount is sitting in our director's fee expense. So if we prepay something, we have to create an asset because we have not utilized this director's services for those 2 months. It's only in the next period we're going to utilize it. So it's an asset for us. We will still have rights to receive that services. So we're going to debit prepaid director fees, which is an asset for 26,200, and we are going to credit director's fees expense. So we have to take it out from the expense. Remember, you can only put it in expense in the income statement if you've incurred this expenditure. We haven't incurred it because we haven't utilized these services yet. So we're going to take it out from the expense number by crediting it for 26,200. Our next example focuses on rental expense. So if we go back, let's get the rental expense amount. It's 90,440. And I'm just going to put that in brackets. A storeroom was rented from 1st February 2021 at 11,200 per month. Rent increased by 7.5% on 1st September 2022. Sorry, that's supposed to be 21. Provide for outstanding rent. Now, this is a very popular type of adjustment that loves to be asked by examiners. So once you have this worked out, the method to calculate this, you cannot go wrong on it. Now, if you will look at our other three examples, in terms of our lecture videos that we provided, we have shared a more in-depth adjustments one that focuses on two extra examples that have similar nature to this. So I advise you to find that that video and work through those as well. Okay. So because our financial year is from 1st January 2021 to 31st December 2021, it means we have only rented this for 11 months because we started in Feb. Now, after that 11 months, up until the end of August, we paid 11,200. And if we count together, it's February, March, April, May, June, July, August. So for 7 months, we paid 11,200. Then for September, October, November, December, which is 4 months, we have to pay an amount of 11,200 times 1.075. So that's the 7.5% increase. And we bring up our calculator. Then the monthly amount goes to 12,040. So the question just said provide for outstanding rent. We don't know how much. So how are you going to know? Well, let's calculate what our total rent expense amount should be. It will be 7 months times 11,200 plus 4 months times 12,040. So it's 7 months times 11,200, which is 78,400, plus 4 months times 12,040, which is 48,160. And that should give you a total of 126,560. But can you see that our expense that was recognized was 90,440 from the list of balances? So there's an outstanding amount of we're going to subtract how much was recognized of 94,440 of 36,120. Let's think about the journal entries. So we've used the storeroom for those months, but we still have to recognize the expense. So we have to debit rental expense for 36,120. And the question was not clear whether the other amounts were paid or not, But for the outstanding amount that we still owe, we know we have to raise a liability. So you can say rental payable or trade and other payables for 36,120. This will sit under your current liabilities. Okay. Our next example is on advertising. Let's get our advertising number of 11,700. It says that the advertising contract has been paid for 13 months. So here they didn't tell you what to do, but you have to know that we have to only occur for it for the 12 months of our current financial year. So let's calculate how much was that additional amount that was paid. So it's 11,700 divided by 13 months, which will give you 900 per month. So because we have prepaid, we are going to debit advertising prepaid asset for 900, and we are going to take it out from our advertising expense because it shouldn't be sitting in our income statement as we have not incurred this expense as yet. Quite a nice simple example that reiterates prepaid asset. With rent income, let's go get our amount before we focus on the transaction. It's 78,400. So that here the tenant has paid 2 months rent in advance. So that means we've paid for the 12 months of the current financial year plus 2 months extra, which will give you 14 months in total. We need to calculate how much is each month's rent. So we divide the amount by 14. That gives you each month's rent income of 5,600. For the 2 months that we paid in advance, we're going to say 5,600 times 2, which will give you 11,200, which was paid in advance. So what we're going to do here is we're going to take it out of rent income by debiting. Remember, an income increases on the credit side, so to decrease it, we're going to have to debit it by 11,200. And we are going to credit a liability called rent received in advance for 11,200. So why did we decrease the income? Again, we've received the money from the tenant, but they have not used the premises for those 2 months as yet. So we have not provided them that service as yet. We have not provided them the right of use for those 2 months as yet. So it's money we've received in advance, but we haven't earned that income. So until those 2 months have passed, we have to decrease it from rent income and recognize as a liability meaning that we have the obligation to provide them the rental property for those 2 months or either return their money back. Now we're going to move on to our final example, which I've said we will cover before when we discuss different types of adjustments, and this is bad debts and provision for bad debts. So in our totals, We have a current bad debt of 2,800 and a provision bad debt of 10,400. I'm just going to put the balances in brackets. Okay, there's two transactions that are happening. So the first is bad debts. These are actual debtors that went bad and we need to write them off. Currently, we've already written off 2,800 Rand worth of debtors. To write off this additional debtors, we are going to debit bad debts expense and credit debtors control or trade in other receivables. There's a few terminology you can use. It'll depend on what the question uses. And that amount will be 4,000. Whatever amount we have already recognized and written off, which is a 2,800, has no impact on the transaction because we are just recognizing an additional amount to be written off. Our second journal transaction deals with provision for bad debts. Remember, it's an adjustment. It's based on an estimate that company assumes that will need to be written off. The current balance is as 10,400. The new estimate is that only 6,080 needs to be provided for as an allowance. So that means we need to decrease an allowance from 10,400. We subtract the current amount of 6,080. So please be careful in the question. Sometimes they'll say it needs to be adjusted by 6,080. If you use the word by, that is the actual movement amount. In this example, they said that it needs to be adjusted to 6,080. So you must make it reach that balance of 6,080, meaning we still need to calculate the movement being the difference between the old balance of 10,400 and the new balance of 6,080. And that means we need to reduce it by 4,320. Now, how do we reduce a provision for bad debts? Well, remember I said it's like a negative asset. You can treat a negative asset similar to a liability in terms of it increases on the credit side and decreases on the debit side. So to decrease it, we are going to debit provision for bad debts. And then we are going to credit provision for bad debts adjustment. Now this goes, because it's a credit, it's going to be in other income in your income statement. If it was a debit, it will be sitting under other operating expenses as an expense. Okay, so this is your balance sheet line item that is subtracted from your debtors balance on your balance sheet, and this provision for bad debts adjustment is the income statement line item. The adjustment is where you will know that that line item is in your income statement. If it's a credit, it's an income. If it's a debit, it's an expense. Well, that's all from us today. I hope it was useful to you. Remember to check our other free videos and adjustments. And if you'd want to get onto our course for the year, to search us on www.eduhans.co.za and you will see our course, which is now going on an offer. So yeah, look out for it, and I hope to see you in future videos.